Standard Chartered sets a $100 UNI price target for 2030. Standard Chartered set a $100 price target on Uniswap's UNI token for 2030, and the token rallied after the call circulated, according to a CoinMarketCap post on June 17, 2026. The bank pointed to Uniswap's share of decentralized exchange volume and the fee revenue the protocol has not yet turned on as the reasons behind the number. A target that far out is a forecast, not a promise, and it sits against a soft tape. As of June 18, 2026, Bitcoin traded near $60.4576, down 1.7% on the day, with Ether around 1,754, 2.2%, and the Crypto Fear and Greed Index reading 22 in fear. UNI moving higher on a single research note while the majors slipped is the part that got attention. The case the bank is making, Standard Chartered's digital assets desk, has built a habit of putting hard numbers on crypto assets that most sell-side research still avoids. The UNI thesis rests on two pillars the bank named directly: Uniswap's position as the largest decentralized exchange by volume, and the revenue the protocol generates but does not currently distribute to UNI holders. That second pillar is the live wire. Uniswap routes enormous trading volume, and the swap fees paid on that volume have historically gone to liquidity providers rather than the token. The long-running debate over a fee switch, a governance change that would direct a slice of protocol fees to UNI, is the mechanism most price models lean on when they argue the token is undervalued relative to the activity it sits on top of. A bank publishing a target is, in effect, pricing in the possibility that the switch eventually flips. A number that depends on a vote. The gap between Uniswap, the protocol, and UNI, the token, is the whole story. The protocol's usage is measurable today. The token's claim on that usage is not, at least not yet, because turning on fees is a governance decision rather than a given. Any model that gets UNI to $100 is implicitly assuming holders eventually capture a meaningful cut of the fees the protocol already earns. That makes the target conditional in a way a Bitcoin or Ether forecast is not. There's no central team that can simply switch on a dividend. It runs through on-chain governance with the legal and tax questions that come with paying token holders out of protocol revenue. The 2030 horizon gives that process room to play out, but it also means the forecast carries execution risk that a price chart alone will not show. Single-token bank coverage is still rare. Single-token coverage from a global bank is still uncommon, and that scarcity is part of why the note had an effect. Most institutional research treats crypto as Bitcoin, Ether, and everything else. A named target on a DeFi governance token signals that at least one large bank is modeling individual protocol economics, not just the asset class. For readers who hold UNI or provide liquidity, the practical takeaway is narrower than the headline. A 2030 target says nothing about the next quarter, and the fee switch question that underpins it remains unresolved governance, not settled fact. Uniswap is also a spend-from-your-own-wallet venue at its core, which means the same self-custody trade-offs that apply to any on-chain position apply here. You hold the keys and the risk, with no provider backstop if a vote or a market turns against you. The broader pattern is worth watching. TradFi desks are increasingly pricing on-chain venues as businesses with revenue, the same way on-chain perpetuals and order books have started drawing institutional flow. A bank assigning a multi-year target to a DEX token is a small marker of that shift, regardless of whether the specific $100 figure holds.